can you please give examples where treaty interpretation differs in cases of double taxation and double non-taxation? Now, it might sound to some of you as a foreign concept, double non-taxation, but that is possible, as you will hear in this session. So treaty interpretation can yield different results in cases of double taxation and double non-taxation, particularly in how countries apply provisions aimed at preventing both of these situations. And some examples are, so let's just first speak about double taxation cases. So the OECD versus the United Nations, UN model interpretations on source versus residence. So in a double taxation scenario, both countries involved in a treaty claim taxing rights over the same income. In other words, country A feels that they have the right to tax the specific company or entity, and country B. And these are often resolved by applying either residence-based or source-based taxation. So as an example, the OECD Model Tax Convention favors residence-based taxation, granting the resident country primary taxing rights with relief measures like credits or exemptions to avoid the double taxation. Conversely, the UN model often provides more taxing rights to the source country, so as it better aligns with the needs of developing countries. This difference can affect tax burden significantly, as seen in cases like the Indian satellite communications case, where India's reliance on source country rights led to double taxation that might not have occurred under the OECD model. Now, obviously, that doesn't mean that you don't get the credit in one of these countries. That's a whole discussion on its own. And depending on the countries involved and the specific, not type of tax, but the source, or let's say the nature of the transaction, will determine if you will get a credit or not. But that's, as I say, it's a different example, and you've got to go into the detail. So interpretation of business profits and permanent establishment rules is another example of double taxation cases. So in this case, the treatment of a PE can also lead to different double taxation results. For example, the Morgan Stanley case, also India, argued that the activities of Morgan Stanley constituted a permanent establishment, or PE, under its domestic law, subjecting it to Indian tax. However, through the TT interpretation under the India-US tax treaty, Morgan Stanley successfully argued that no further profit could be attributed to the PE, as the profits were already taxed in the US. Thus, the treaty's application allowed for the relief of double taxation that might otherwise have occurred. So that's a good example of that. But now let's get to some of the more controversial type of situations, double non-taxation cases. So first one is hybrid entities and mismatches. So hybrid entities and mismatches in the classification of income sources can result in a double non-taxation situation, as each country may interpret the entity or income differently under its domestic law and the treaty. So, for example, in the French bank case with a US client, the bank exploited the differences in the classification of debt and equity under the France-US treaty. France saw the payments as interest, which is non-taxable in France, while the US did not tax them either, resulting in double non-taxation. Now, this is quite a unique situation, but it is possible. And then another example of this is the use of the principal purpose test, which is becoming more and more relevant, especially in anti-avoidance situations. So the anti-avoidance measures under the BEPS Action 6 led to the inclusion of the PPT, which is called the principal purpose test, in many treaties, aiming to prevent treaty shopping and double non-taxation. So the Danish beneficial ownership cases highlight this application quite well. Denmark sought to prevent multinational corporations from routing their funds through low tax jurisdictions to avoid tax entirely. The interpretation of the PPT allowed Denmark to deny treaty benefits, where the primary purpose, remember that's the principal purpose test, was tax avoidance, targeting double non-taxation cases effectively. So as one can see, this situation is real and one needs to be careful. I think as a rule of thumb, be very careful to set up structures unintentionally in such a way that you don't end up paying tax, as that will come later to bite you, and you're probably going to have to produce a whole lot of documentation to support it many, many years later. Another one is interpretational differences in dual resident companies. So that's where the POEM test comes in, the place of effective management, when a company is dual resident, in other words, under domestic law, in two different countries, treaties often apply a POEM test to establish a single jurisdiction for tax purposes, preventing double taxation. Now, that's not always the case, but the idea is that you will then determine which is the principal taxing jurisdiction, especially where both have differing standards for management and control. And remember, the POEM test is, I like to call it a subjective test because it deals with the interpretation of the words management and control. And in different types of, or different jurisdictions across Earth, you'll see that you have different interpretation on this. So that's the POEM test. Then you also have the beneficial ownership concept and its interpretation. So that deals with dividends, interest, and royalty payments. And here we have the Prevost Car Inc. versus Canada case. Now, Canada attempted to deny treaty benefits by arguing that the Canadian subsidiary's Dutch parent was not the beneficial owner. Remember, that's why we're calling it the beneficial owner concept, potentially creating double taxation. However, the court upheld treaty benefits based on a narrow interpretation of beneficial ownership under the Canada-Netherlands Treaty, thus preventing double taxation. So as one can see, these examples underscore how nuanced treaty interpretations can create outcomes of double taxation or double non-taxation, and it highlights the importance of precise, context-sensitive application of treaty terms. And I would say, I'd like to add also that your documentation reflects, the reality of the transaction, and one needs to go and make 200% sure. When you see it, there's a level of interpretation that becomes quite subjective. Rather go and be very clear in the documentation so that there's no uncertainty, and then make sure that the activities are in line with what the documentation actually says.